Private credit has swelled from a $235 billion industry in 2008 to over $2 trillion of assets under management today. These are giant investment firms like Blackstone and Apollo that lend directly to companies with much less regulations and oversight than banks. So could private credit be the next boogeyman in this time of high interest rates? Let's see how it operates to find out. These firms raise trillions of dollars from a variety of sources, including public and private pensions, private funds, and insurance companies, among others. That capital is locked up for long periods, meaning it can't be pulled out in a panic, giving these lenders stability. They then lend this money directly to businesses, often the very ones considered too risky for commercial banks, in exchange for higher interest payments. Yet it remains largely unregulated and almost completely opaque. And many see that as a red flag, because the parallels to 2008 are hard to ignore. Parallels that suggest it could potentially be the next break. First, the high-risk borrowers. By definition, these are companies that traditional banks won't lend to, making them extremely vulnerable in a recession. And because most of these loans have adjustable rates, the rate hikes of the last 2 years have already put these companies under immense pressure. This chart shows how easily U.S. companies can pay their debt. Lower numbers mean they're struggling more. And we're at the lowest level since the rebound from the 2008 financial crisis. So higher for longer rates could strain the ability of these borrowers to manage their debt. And we saw the effects of that problem in 2008. Second, there's leverage. While these funds are less leveraged than commercial banks were in 2008 by a good margin, they still use borrowed money to finance their loans, which magnifies both gains and losses. And they carry more debt relative to their earnings, which raises their risk exposure and has caused a real concern. And third, valuation uncertainty. The value of these private loans isn't set by public markets. It's set by the fund's own internal models. Critics worry these valuations could be hiding significant unrealized losses, just like the mortgage-backed securities in 2008. This could potentially hide risk, emphasizing that they operate largely in the shadows, hence their name.